Welcome back. In the wake of the Silicon Valley Bank crashing late last week, which resulted in the second largest bank failure in history, we are talking dollars and cents with my friend Colin Evans from Evans Financial Group about the in-depth questions I think many of us are actually wondering at this time. I'll go ahead and start off with this, and then you can take it from here. Colin, what happened and why did it happen?
A couple things. Typically when we go into a bank and we deposit money, banks typically do two things with it. One is they're lending it out to others so they can, generate revenue off of that interest, or they're buying treasury securities. Well, and what happened with this, we just came from a really, really low interest rate environment, and now that we've had, had to deal with inflation and things of that nature, I believe our banking system a little bit got, I'd say, kind of lazy, thinking that we weren't going to see inflation as bad as we did, and things like that weren't going to really happen. Well, in that event, that actually made the treasury securities that they purchased, now that interest rates are much higher, it made the value of those decline. And that kind of put a little bit of a crunch, saying, hey, like the Silicon Valley ones, like we need to generate capital or raise money so our banking sheets look better.
Right.
That caused people to kind of freak out, and kind of caused a little bit of what we could say, in essence, was a run on the bank.
I was wondering about that. I'm glad you're touching base on that. Okay, keep going.
So, we have that, and Uncle Sam, steps in. They've got to jump in with the FDIC and kind of take over, and they're making depositors whole. Well, what just occurred, and what we're seeing now is the FDIC insured up to $250,000. Per individual. And now that we're seeing this, they had an SVP, the Silicon Valley Bank, had over 90% of their depositors had over that amount. Well, that kind of put it at risk, and so they're stepping in saying, hey, we're going to cover the difference so the banking clientele are made whole.
Okay.
There's a little bit of run on, I'll say, tech industry where this came from, because Silicon Valley being that was the our hub for years of technology. Well, that's one of the news things that we read earlier this week was Etsy, people that make crafts and things of that nature.
Sure.
That's where Etsy banked. And so they had a little bit of a halt, and it got put on hold with paying their, their sellers, as well as collecting funds and things of that nature. So now FDIC is jumping in and really kind of lending a hand on that and making the depositors whole again. So there was a gray area, of course, that kind of does scare everybody. And, especially if you've got a fixed income or you don't have access to, like, this is my money,
Right.
Now what are we going to do?
I mean, I was wondering, are people running for the banks to take out their money and, put it underneath their mattress? What are you guys hearing?
You're going to see a little bit of that. You are, because that's, human nature is, we go back, what was it, 2 years ago when toilet paper, there was a run,
Right.
there was a run on that.
Yes,
And it was like, what's
yes.
the toilet paper have to do with COVID?
Yes.
So similarly, that causes a run on, depositors going, hey, do I need to go stick this under the mattress? In a general consensus, one thing I think the biggest lesson for people that are depositing at banks is if you've got over that FDIC number of 250,000 that's insured, it might be time to just reevaluate and say, maybe I don't need this, these eggs all in one basket or one bank, and it might be time for us to, let's split this into a couple different banking institutions.
And Colin, real quick, what are the banking industries or the federal government doing right now to reassure people that this isn't going to cause some domino effect?
Yeah, well, we just saw releasing this morning of the bank term funding, and as we're looking at that, and what they're kind of doing with this precedence being set, because now FDIC only insured up to $250,000. Well, now that the government's stepping in and saying, hey, we're going to make depositors whole again, above and beyond this, is really putting the consumer at ease, so we don't see this run, and we're not having people freak out that they can't get to their assets or they can't get to their banking money. And Uncle Sam is coming in and doing that, and for Silicon Valley as well as Signature that they just took over this a couple of days ago. So in the essence of them doing that and making people whole again, that does restore consumer confidence, but it's still going to be one of the tickers in the back of our heads going, are we sure?
Absolutely.
If this isn't a fly-by-night bank or something along those lines.
That's absolutely correct. Again, Colin Evans from Evans Financial Group with your weekly financial update. Colin, thank you so much for shedding light on some of these very serious questions. I know our audience does appreciate that, so thank you for coming.
Thanks for having us.